In the interest of time, we will get started. So, Alejandro, welcome, please.
Okay, so good morning, everyone. My name is Alejandro Casado. I'm a research economist at the Financial Stability Department here at the Bank of Spain. And I want to first thank the organizers for inviting me to present at this amazing conference. And today I'm going to present this paper entitled Banks Specialization and Private Information that is co-authored with David Martínez-Miera from Universidad Carlos III de Madrid. So first, I'm going to spend around 8 to 10 minutes talking about the main contributions of the paper, but also introducing and motivating it. And then the rest of the presentation I'm going to spend on talking about the details on the empirical analysis we make. So this paper relates to a long-standing literature on the special role of banks in allocating resources. And in doing so, banks take into account several components. And one of the key components is information acquisition and information generation. And banks, in order to acquire and build such information, rely on their screening and monitoring role. And I want to highlight, since the beginning of the presentation, that we are going to focus on corporate borrowers. There is a well-established characteristic in the literature called relationship lending that has been analyzed in many papers, through which banks acquire information from only one borrower. So through relationship lending, banks are able to acquire borrower-specific information. While in this paper, we are going to focus on a different characteristic, bank lending specialization, through which banks acquire information through different borrowers that share a common characteristic that could be the same geographical market, the same sector of activity, or even the same export market. And in this literature, there is a common standard and important assumption, that is that banks, where they specialize, they gain an informational advantage. So banks gain higher expertise, skills, or even technologies in assessing corporate risk where they specialize. So this assumption is as follows. Bank specialization is linked to better private information. This has been made across several papers, such as in this very influential paper by Daniel Paravisini, that is also here with us in the table, and his co-authors Veronica Rappaport and Philip Snavel, published in the Journal of Finance 2023. And there is another important and relevant paper in this literature by Christian Blickle, Cecilia Parratore, and Anthony Saunders, that is forthcoming in the Journal of Finance, where they examine the relationship between specialization and loan default, with a focus on sector specialization. But there is an important data limitation in their paper. Their sample is biased to large banks, to the largest US banks that are subject to stress tests, and more importantly, to large firms, because they have information only on loans over $1 million US. And here is where our paper enters. We take the advantage of using the Spanish credit registry, where we can observe the universe of banks and firms with active loans in Spain. And why is this relevant? This is important because micro and small firms are the backbone of several economies, such as the Spanish one, where they account for 95% of the total number of non-financial firms, more than 40% of total employment, and almost 40% of total corporate lending. And here is where the first contribution of our paper comes. We show that different dimensions of specialization matters for different types of firms. And specifically, we are going to provide evidence that local specialization matters for small firms, while sector specialization matters for large firms in the context of loan default. Let me, with this slide, rationalize a little bit this first contribution. So the performance of a firm might depend on several factors. And across these factors, there might be firm-specific, local-specific, and sector-specific factors. And depending on the particular firm the bank wants to assess the performance of, some of these factors might be more relevant. So using this example, where we have 3 different manufacturing firms, where the first one produces artisan and exclusive furniture, the performance of this firm might be more linked to firm-specific factors, such as, for example, the health status of their employees. But for the second firm, that is a small manufacturing firm that produces standard furniture and focuses on local sales, the performance of this firm might be more linked to local specific factors, such as, for example, local economic activity. And at last, the third firm is a large manufacturing firm producing standard furniture that exports most of the production. So the performance of this firm might be more linked to sector-specific factors, such as trade policies or import tariffs. So in this paper, we argue that different dimensions of specialization allow banks to gain informational advantages that matters differentially depending on firm types. This is also consistent with this literature on relationship lending that emphasizes that relationship benefits are stronger for the smaller sample of firms. And now, let me go to the second contribution of the paper. Again, as I have already told you, there is a common standard and important assumption in this literature that specialization is linked to better private information. But there is no paper providing empirical evidence on this regard yet. This is what we are going to try to do now. I need to acknowledge here that we cannot claim causality in our paper. We do not have exogenous variation in the specialization variable, but we are planning to exploit things like mergers and acquisitions as a plausible source of exogenous variation in this characteristic, but we haven't done it yet. So in order to provide evidence on this link, we are going to rely on banks' private risk assessments as a measure of banks' private information. This is an approach taken by recent papers, such as these amazing papers by Gregory Weidner and co-authors, but also a recent paper by Klesens, Ongena, and Wang used these internal risk assessments as a measure of private information in the context of relationship lending. So, using these estimated PDs reported to regulators by IRB banks, we are going to provide the first empirical evidence on the direct link between specialization and better private information. And specifically, we are going to show that for micro and small firms, the PD reported by the bank with the highest degree of local specialization predicts default better than the PD reported by the bank with the lowest degree of local specialization. And we are going to show the same for sector specialization and medium and large firms. So at least, so far, I have explained the 2 main contributions of the paper. And now let me get into the details. This is the agenda for the presentation, but no worries, I'm going to focus only on the important parts. So these are the 2 research questions of the paper. Are geographical and sectoral lending specialization related to loan default differently depending on firm size? And also, is specialization directly linked to better private information as prior literature has assumed? We are going to use the Spanish Credit Registry as a laboratory to answer these 2 questions. Let me go quickly through the literature review to spend more time on the interesting parts. So again, we contribute to all these papers on the special role of banks in screening and monitoring borrowers, and especially on the papers on bank lending specialization. These papers argue that banks, where they specialize, may gain an informational advantage, but there are also papers showing how this characteristic affects the transmission of SOCs and monetary policy, but also how these characteristics affect different outcomes, such as corporate innovation or even zombie lending. We also contribute to the papers on the use of banks' internal risk assessments as a measure of private information. I think there is some problem, well, no worries. As a measure of banks' private information, despite there are some papers arguing that these estimates might have some biases. As these papers, these amazing papers by Rainer Hasselmann that presented yesterday an amazing paper here at the conference. And at last, we contribute to the literature on small versus large firms that highlighted that small firms are the ones that might face stronger asymmetric informational problems. So, in terms of the data, we are going to focus on the Spanish credit registry from 2018 to 2024, because during this period, we have most of the information that we need to answer for these questions. We observed several loan characteristics in the data, and importantly, 3 firm characteristics: the size of the firm, the geographical market where the firm is located, and also the sector of activity of the firm. And let me go directly to the important variables of the paper. Let me start with local specialization variable. We use as the relevant local banking market municipalities. In our robustness test, we have that our results hold to a different use of the local banking market, but also we have in the appendix some results supporting the use of municipalities. So this variable is computed as the simple ratio between corporate lending of a given bank in a municipality and period divided by total corporate lending of a given bank in a period across all municipalities. We use as the municipality of the firm where the firm is headquartered. So this might be possibly linked to economic activity for small firms in a higher way. Just for the ones that haven't seen a specialization paper before, I can imagine that all of you have seen one, but just in case, this is a simple example of this variable where a bank originates corporate lending in 2 municipalities. It originates $9 million euros in municipality A, 1 million euro in municipality B, so its degree of specialization is 0.9 and 0.1, respectively. This is the variable we use in the paper for our main results, but in our robustness tests, we have several different specifications, such as using excess specialization or taking out the exposure for the specific firm to compute this variable, etc. And just for the illustrative example I'm going to show you later, we compute excess specialization because it helps to the illustrative example I'm going to show you in the next slide. This excess specialization is a measure of overinvestment. We compute this aggregating corporate lending of all banks in a given municipality and then computing kind of a degree of local specialization of the average bank. And we use that measure to compute overinvestment excess specialization for all banks across local markets. This is useful for this type of graphs. I need to say here that our identification strategy is already taking this into account, already takes into account the size of the market and the size of the sector. That's why we only use in our main results the simple ratio. So here, what you have is an illustrative example of this variable, of the local excess specialization. For confidentiality reasons, we cannot disclose information for individual banks. So here we have the average excess local specialization for a group of 3 different banks. And what you can observe is that they are highly specialized over the northwest region of Spain, over the province of Galicia. And if we zoom into that province, you can see that this group of banks is highly specialized across certain municipalities. So with this example, I think you have understood which is the first heterogeneity we are exploiting in this paper. And then we compute sector specialization in the same way, but using sectors instead of municipalities. We use 21 different sectors, but exclude financial and insurance activities as a common approach. And just to show you the same illustrative example as before, you can see that this group of banks is highly overinvested, is highly specialized in the agriculture and fishing and real estate sectors. And just one more detail about the data. This is what we are going to use to interpret our first set of results. We are going to use the average degree of local and sector specialization in the top municipality or sector versus the average local or sector specialization in all other municipalities or sectors to interpret our first set of results on the relationship between specialization and loan default. And now, let me spend the 9 minutes that I have talking about the two main set of empirical results. Let's start with the results on specialization and loan default. Here we are going to run the regression over here. We are going to use loan level data, but we include loans only once at origination. And importantly, the dependent variable is a forward-looking variable. It is an indicator that equals 1 if the loan that is originated within this period ever defaults until maturity or until the last period we observe it. And we want to examine the relationship between this variable with local specialization, that is captured with the beta 1 coefficient, and with sector specialization, that is captured with the beta 2 coefficient. Here we include a long set of controls. We include loan controls such as the amount, the secured status, the interest rate, the product type. We also control for relationship lending, including the relationship length for each bank firm pair. And we also control for local and sector market power, including local and sector market shares. And I want to highlight here that we include two main sets of fixed effects. We include bank time fixed effects to be effectively comparing loan exposed default for a given loan originated in this period by the same bank across different municipalities or sectors where the bank has different degrees of specialization. And we also include municipality, sector, size, time, fixed effect to be comparing within similar types of firms, a la de Grice et al. 2019. Here, we do not apply a Quajamian style regression, including firm type fixed effect, because we would be capturing in that way to which bank the firm is defaulting first. And while that's super interesting, that is out of the scope of this paper, and that would answer a different question. And now let's go to the results. Let me show you the results first graphically. Here you have the relationship between local specialization and loan default for firms having different sizes. And what you can observe is that local specialization is negatively correlated with loan default for micro and small firms, but not for medium and large firms. And this can be interpreted in the following way. A loan granted by a bank to a micro or small firm in its top municipality is 0.84 or 0.75 percentage points less likely to default exposed compared to other loans. And we can see the same for sector specialization and loan default. But here, what we can observe is that the negative relationship between sector specialization and loan default appears for medium and large firms, and not for micro and small firms. Here, there is a positive relationship between sector specialization and loan default for micro firms. That is something that we cannot explain yet because we don't understand it, but we will do further analysis to try to explain this unexpected coefficient. And now let me show you this result again, quickly, in a table format, because I want to emphasize on this set of results because this is the first contribution of the paper. We show, again, that local specialization is negatively correlated with loan default for micro and small firms, while sector specialization is negatively correlated with loan default for medium and large firms. And then we have an extensive set of robustness tests for the less explored dimension of specialization, for local specialization, but for the sake of time, let me skip this. Just tell you that these results are super robust to several specifications of the specialization variable, sample periods, construction of the dependent variable, and also to alleviate concerns related to the right censoring of the dependent variable, for example. So far, I have told you that different types of specialization matters for different types of firms. And now, let's see the evidence we have for this direct link between specialization and better private information for the second contribution of the paper. So again, just one more time, I promise this is the last time I say it, there is a standard assumption in this literature that relates specialization and better private information. We are going to provide evidence on this link using internal risk assessments. And specifically, we are going to use the PDs, the probabilities of default reported to regulators by IRB banks. These PDs can be defined as the probability of default of risk holders during 1 year. And we have this information for 4 major Spanish banks that account for almost 70% of total lending. And I don't have time to show you this here, but we have some statistics showing that even these large banks specialize geographically and sectorally. It is true that they specialize to a lesser extent compared to the small banks, but we still have heterogeneity for this analysis here. So given our previous results on loan default, we are going to examine if the PDs reported by banks that are highly locally specialized predicts default better than the PDs reported by the bank with the lowest degree of local specialization for micro and small firms. And we are going to analyze the same for sector specialization and medium and large firms. We are going to use, for this, bank firm quarter data for the period where the PDs are available. And we are going to do kind of a within firm analysis. We are going to use firms that have at least 2 PDs reported. Okay? In order to evaluate the performance of PDs in predicting default, we are going to use a common approach in the literature, the area under the receiver operating curve, the AUROC. I don't have time to show you how this is computed, but what you need to have in mind is that this area under the curve can be interpreted as a measure of how well the PDs predict realized default. So we are going to compute the ROC curve, and the area under this ROC curve can be interpreted as how well the PD predicts realized default. And let me go to the result directly. Here you can see the result for local specialization and micro and small firms. What you can observe is that while both PDs predicts default pretty well, the PD reported by the bank with the highest degree of local specialization predicts default better than the PD reported by the bank with the lowest degree of local specialization. And just for you to understand this a little bit better, let me interpret this result. So given a randomly chosen defaulting and non-defaulting micro or small firm, the probability that the defaulting firm has a higher PD than the non-defaulting one is 83.38% for the locally specialized bank, 82.47% for the locally non-specialized bank. So it is almost 1 percentage point higher for the locally specialized bank. And this difference is statistically significant. But also, it is economically relevant, because as highlighted by this literature, such as in this paper by Ruzzier, María, and co-authors, even a 1 percentage point improvement in the area under the curve is considered something relevant in the credit scoring industry. So, as I'm running out of time, let me go quickly through this last part of the presentation. We show a similar result for sector specialization and medium and large firms. And in the paper, we have some additional analysis that in this short presentation I cannot show you, but if you are interested on them, let me know and we can talk about them during the coffee break. I would love to do that. And yeah, so let me conclude quickly. In this paper, we have two main contributions. First, we show that different types of specialization matters for different types of firms. And specifically, we show that local specialization matters more for small firms, while sector specialization matters for large firms. And our second contribution is providing the first empirical evidence on this direct link between specialization and better private information. So thank you, everyone.
Alejandro, so now we move to the discussion by Gianmarco Ruzzier from the Bank of Spain.
Okay. So first of all, thanks everybody for being here and welcome, and thanks a lot the organizer and the chair for giving me the chance to discuss this very nice paper by Alejandro and David. So let me quickly review the paper, since Alejandro had already did an amazing job explaining it. What this paper is essentially doing is they try to uncover the link between bank specialization, either local or sectoral, and private information. Okay? And most importantly, they're trying to understand if and how bank specialization is first related to information advantages, proxied by lower loan default delinquencies, and whether this is dependent on firms types. Okay? So they use this credit registry for Spain, focusing on commercial and industrial loans. And what they do is that they measure the share, like the exposure that each bank has to a certain municipality or sector. Okay? And what they find is that local specialization is inherently related to lower defaults and better prediction, especially for micro and small firms, whereas sectoral specialization is inherently related to lower defaults and better prediction for larger firms. Okay? So, now, why this paper is important? This paper is important because it shows that specialized banks are better equipped to screen and monitor borrowers. However, the key contribution is that they show that the benefits of specialization crucially depends on firms types. Okay? And moreover, they emphasize the link between bank specialization and enhanced private information. So overall, this is a very nice paper that sheds new light on novel facts about bank specialization. Now, here starts my part, giving you the comments. I mainly have 3 sets of comments and then a minor comments section. So the first one is a very cheap but relevant comment. You might have this issue that Alejandro already discussed about, that banks may sort in areas that ex ante have already lower default risk. Okay? So you observe bank specialization, so these banks specialize because they want to go in these areas. So as a simple suggestion, is if you don't want to go with a full-fledged IV, is just to compare municipalities and sectors' default probability in high and low average degree of specialization areas. If you don't find a strong evidence, this is good for you, because this shows that this cannot explain the large chunk in default probability. And also, this is also related to the composition of concentration in this market, which I think is also very good to document. Alternatively, you can go full-fledged, as you already said before, and use natural experiment like mergers or branch closures that could serve as an IV for specialization. The second part of my comments has more to do about the mechanism, okay? So you essentially say that specialization, or like the benefits of specialization, are firm types dependent, okay? the reason for that, you argue in the paper, it's because these firms are subject to different types of shocks, and banks, by focusing on these different markets, they actually get to learn that these types of shock are more relevant. So my idea here is use different types of shocks to actually understand what's the mechanism behind your results. Why? Because we know that specialization is essentially related to two types of risk. One is funding risk that works in this way. So banks have better information in their top municipalities, so they gain higher profits, materialized in lower defaults for smaller firms. However, this raises the ex-ante funding risk for these banks because they lack diversification. And we know from literature that when they're hit by a local bad shock, this lowers the profits of the banks, but these banks that are more specialized, they actually shield their lenders in which they're specialized, and they act as a risk absorber. And where you should see that these results are stronger, well, for smaller firms, because they cannot substitute across lenders. Similarly, we know that local specialization is also related to risk-taking behavior, where financial booms, we know that generates risk-taking attitudes. Here there are plenty of people that contribute to this literature. However, when you have soft information, these incentives are curbed down because these banks redirect the loans to safer firms. So the idea here is to use local booms. These banks will have lower risk-taking behavior, who will benefit from these smaller firms, and you can take this example by Granger. So again, the idea here is to use different types of shocks with the interaction of this specialization to document the mechanism, have a sort of direct evidence to rationalize this dependency of the informational benefits. The second part is the nature of this private information. So are these banks better at screening, or are they better at monitoring? And here you have amazing data because you have the probability of defaults that is measuring actually the 1 year ahead probability of default. So it's updated. And you can use the frequency of updating across specialization, banks that are differently specialized in sectors or location, to document whether the frequency is different and then see how they update, whether they update faster under some sort of shocks. The idea here is simple. If you see that there are fewer updates and unconditionally higher AUC, then this relates to ex-ante better screening ability. If they update frequently instead and they improve the AUC after the shocks, then this is related to better monitoring and learning. Finally, this is your same set of data. It's just a snapshot of 2024. It's true that in your data you have very low collateralization, around 3%. But actually, the use of personal guarantees, it's very high, and is especially concentrated in small firms. And most importantly, in 90% of these cases, when these firms, smaller firms, use personal guarantee, they have full coverage. So here the question is specialization related to the fact that these banks are actually taking off the risk and passing it to borrowers, or they are disciplining the borrowers via better monitoring, and so they don't need to use the personal guarantee. So this is all related to this literature of risk transference and information. So here you can simply document the distribution of this personal guarantee for different degree of specialization. If you see that they concentrate, this is actually showing that these banks are not exploiting information, but they are concentrate in a markets where they are risk-loving, and they pass the risk to the borrower that cannot default. If instead you see that they don't use it, this is very good for your story because they have superior information. If you don't see a difference, this is also good because then you can say, conditional in having a guarantee, are they still performing better in terms of PDs or the AUC advantage? So how much time I have? 2 minutes? Okay. So the last two comments that I have is, well, complementary susceptibility. This, again, is a cheap comment, but I think it's relevant. We want to understand whether sectoral specialization and local specialization works together or not, and how they are related on relationship. Unfortunately, you didn't manage to go over these results, but they are very interesting, believe me. So here you can simply have, standard interaction, understand whether you have stronger performance for lower degree of the interaction, either on sectoral specialization or relationship lending. This is a sign that they work as substitute. If they go hand in hand, stronger performance when all of these levels are high, this is a sign of complementarity. And finally, minor comments, but relevant, since you show that these effects are so huge and so good for the bank, why not all these banks are specializing in one sector or in one municipality? So here I would like to see how the portfolio volatility of these banks differ in terms of their degree of specialization, what types of banks specialize and which not, just to have a better understanding of how this is related to the size of the firm. And finally, you give a lot of evidence on firms, bank side, but are these firms squeezed or not? So why don't you explore firms' profitability, conditioning on the size, and understanding how the match works and whether they benefit or not. So again, thank you very much. Very nice paper. I really enjoy reading it. I really recommend you to read it. I hope to see the new iteration soon. Okay? Thanks.
Thank you very much, Gianmarco. Do you want to answer very briefly?
Yeah, very briefly, because I know that we are going to be able to talk a lot about this. So thank you for the discussion. Thank you for reading the paper and all the comments and suggestions. So regarding this endogenous problem, it is true that in our identification strategy we already control for local factors and sector factors, but it is totally true that exploring whether banks specialize in areas with high or low default probabilities, I think that would speak into the endogeneity problems that we might have, so we will do it for sure. We have in our to-do list also to exploit these mergers and acquisitions, also branch closures. That's a good idea as a possible source of exogenous variation and specialization. In terms of the mechanism, that's totally true. We don't have a long sample period, but we still can find some shocks to try to address which is the exact mechanism behind our results. And we also could use these PDs because they are updated quarterly, so we could examine that. And the last thing I want to say is that we did some analysis on the interactions between local and sector specialization, because there is also a paper by Daniel with people with economists at the Central Bank of France, where they find that that is important. In Spain, it doesn't seem to be that important, at least in terms of loan default, but we will explore deeper the relationship with relationship lending, because that might be something relevant, and this has also been highlighted before by Manuel Arellano also, when I presented the paper in another place. So yeah, thank you so much for the discussion.
My pleasure.
Okay, so now we have some time for questions from the floor. Please, can you bring the microphone over here? Yes, can you bring the microphone over here? So, Rafa.
Okay, thank you. Now, you focus on the borrowing firms. What about the lending banks? Is specialization a characteristic of smaller banks? The top 3 Spanish banks, I presume they lend to all sectors in all locations.
Can I answer, or should we take more?
How do you want to do this? Okay, so let's take 3 questions and then you can answer. Javier?
Thank you for the presentation. I think that, as I see this paper at the moment, the results are highly exploratory. I would like to get some clarifications on the following. So I was a bit confused in your introduction of the topic on whether you are considering a world in which a specialization of the lender affects the probability of default of the borrower, say through monitoring. So monitoring has the capacity to alter the probability of default of a given borrower. Or in contrast, you are just considering that the lender who is specialized has a greater capacity to predict a given probability of default. I think these are very different worlds that will require very different empirical strategies. They are not necessarily incompatible, so you might have a mixture of both things. Then when you consider the regression in which you say the dummy for default equals 1 if a loan ever defaults. I'm a bit worried about the variation in the horizon there. So why not to focus on predicting probabilities of default within 1 year, which is the horizon consistent with the estimate of the PD, and do that on a rolling basis, because otherwise, I mean, maybe observing a firm over a longer horizon is already telling you something about the viability of the business or the relationship in the background. You have a strange result, you say a strange result that micro firms' specialization is associated with higher PD, right? You say you still have to interpret what is going on there. But this could precisely reflect what is a specialization about. So it could be that a lender is specialized into treating distressed firms. So instead of searching markets where PDs are low, is actually specialized in dealing with firms that have a higher probability of default, but may still provide you good lending opportunity. Okay, so I see like a lot of potential questions to answer going forward. Thank you very much.
Have time just for one more question.
Thank you very much for the presentation. So I have one question made of 2 parts, but one is related to Rafael, and it's simply, I don't know if you're able to with the Spanish credit registry, but what if you remove the top 3 banks? I was thinking this might be related to the result about lending that you couldn't explain. And the second one would be more like about the estimation bias of these PDs. So once you compare them, whether you get different results if you use 2 subsamples. The first one including the COVID, and the second one including instead the tightening. This is more just, I think it would be interesting for, many theories about.
Well, so thank you very much. We are out of time here, so maybe you can...
I will answer later to all of your questions. Thank you.
So now we are moving to the second paper in this session, which is about bank supervision and non-performing loan cleansing. So Serafeim, please.
Yes, good morning, everyone. Thank you very much. Can I have both? Yes, great. Yeah, thank you. So let me also thank the organizers for the opportunity to present this paper, which is titled Bank Supervision and Non-Performing Loan Cleansing. My name is Tsoukas. I'm the University of Glasgow. It's co-authored with Baskaya, who is also based in Glasgow, and with my 2 good colleagues from co-authors from the Bank of Spain, José María Serena and José Gutiérrez. They're both here, and I thank them very much. So let me, well, the usual disclaimer applies, and let me start with a little bit of background and motivation behind this paper. So what is generally accepted is that following extreme economic events, financial crisis, etc., banks tend to accumulate large amounts of non-performing loans, the so-called NPLs. Now, this is quite problematic because not only high levels of NPLs harm the balance sheet of the banks, the high levels of NPL can negatively affect the economic activity. They can, slow down the post-crisis recovery, and generally speaking, it's undesirable for the overall financial stability of the banking sector. Despite that, banks have a discretion in how they manage non-performing loans, and they actually have an incentive to keep non-performing loans at inefficiently high levels. The main reason behind this incentive is that if they recognize the loans and if they provision for them, their short-term profitability, the short-term accounting profits will take a hit. For this reason exactly, supervisors have every reason to monitor closely the asset quality of the banks and whether actually banks manage non-performing loans in a timely way and very soundly. And in line with these, European authorities over the past years, especially in the aftermath of the European sovereign debt crisis, they have decided to undertake a number of initiatives to handle the non-performing loans of European banks. Again, the idea here is to strengthen the NPL supervision and make sure that the loans are handled appropriately. However, despite the importance of these policies, there is very limited evidence about whether such policies are actually effective in reducing non-performing loans and whether they may improve bank lending. And this is somewhat surprising, and to some extent this is one of the main contributions of our paper. What we wish to do is to use very granular data and analyze how supervisory guidelines, rather than legally binding requirements, can shape banks' actions. And as the previous paper by Alejandro, we rely on granular loan level data, so we rely on the CIR, and we match firms and banks. As I said already, the idea behind the policy initiatives that have been undertaken over the past years is to increase the provisions for non-performing loans. And the specific initiative that was released by the ECB, for which I'm going to give you more details in a minute, was, as I said, a legally non-binding, so it was framed as a non-binding policy. However, banks had to either comply or explain any deviations regarding the performance and then the disposal of bad loans. So having said that, the main aim of this study is to look at this policy intervention and study three interrelated outcomes. This is the disposal of the NPLs, the probability to dispose the NPLs, the dynamics behind lending, so what happens to the supply of lending, and then finally, we'd like to take this to the firm level and see what happens to the real economy. So these are the three topics that we're going to explore. And if I can give you a brief summary of what we find, we actually saw that the introduction of the ECB policy was quite effective in terms of ensuring that banks had a desire to dispose faster non-performing loans. But more than that, banks that were more heavily exposed to the policy, they actually tightened their lending. And not only that, they were requiring high levels of collateral. I will show you that they terminate bank relationships. So we find that there are actually effects at the bank level. And the third set of results, as I said, we will be looking at the firm level effects, and I will show you that for those firms that borrow from banks with older NPLs, then before the policy, these banks actually suffer in terms of their investment, their employment, and other real activities. And if anything, the effect is stronger for the riskier firms. So we do find that the policy had an important effect for the economy. Okay, so now I think I'm ready to introduce the relevant literature. Again, I'll be brief, but there are three key areas of work that are related to our study. One is the determinants of non-performing loans. So there's a number of studies that actually look what are the key drivers of non-performing loans. And the main summary is that it boils down to macroeconomic conditions and bank-specific characteristics as the key drivers of non-performing loans. Another line of work that is relevant to our study is whether there's a direct link between high levels of non-performing loans and bank lending. Again, there is evidence that shows that the two are related to each other, but it's really hard to identify causal relationship in absence of any exogenous event, for example, natural experiment, and proper control for firm demand, which is what we offer in this study. And the final line of work, which we think is probably the closest to ours, is how tighter supervisory interventions affect the supply of credit, although previous studies mainly focus on interventions that are binding. We are looking at a policy change that relies on guidance. And we think that this is important because it gives banks, some flexibility about the decisions that they make. So these are the key strands of the literature that are related to our work. So now let me take a minute or two just to introduce you to the policy that we are looking at. Let me remind you that the background, the main reason that banks decided to intervene, especially the ECB, was to help banks to resolve their non-performing loans. Post-European sovereign debt crisis, non-performing loans were at high levels, especially for the periphery zone, and they wanted to push for a discontinuation of the wait and see approaches. So they wanted to see this problem resolved. And that also added to transparency of the ECB about the way that banks treat NPLs. So following a consultation between banks and the European Central Bank, in March 2018, the ECB released the so-called non-performing loan provisioning guidelines, and that was a policy document that gave quantitative criteria about two dimensions of the non-performing loans that are critical. One is the time that the loan is spent in a non-performing status, which is what we call vintage. And the second criterion is the collateral, whether a loan is collateralized or not, whether it's secured or unsecured. So these two criteria are very important because, as I will show you in this table, which is taken directly from the policy document, quite unexpectedly, the ECB decided to focus, separate non-performing loans between secured and unsecured. For unsecured loans, the expectation was that they should be fully provisioned in 2 years' time, and for the secured loans, there was a stepwise provisioning starting from year 3 up to year 7. So these specific requirements, actually led the banks to act upon it, and it was a tighter and more specific guidance about how to dispose the vintage, the older NPLs, the ones that have been sitting on the bank's balance sheet for quite some time. And we saw that these guidelines were issued as I said, in 2018, but some consultation obviously took place before that between the banks and the ECB, but clearly the criteria in these provisioning guidelines were largely unanticipated by the banks and the market participants. The granularity of the policy made it very difficult for banks to foresee these specific details. And if anything, we conducted an exercise where we find negative abnormal returns for Spanish bank stocks around the announcement of the ECB policy. So we think that we can claim that this event was largely unanticipated by the markets. The data that we use, as Alejandro mentioned in the previous paper, we use the Spanish credit registry, so extremely detailed data. We look at Spanish non-financial firms. Banks include rural banks as well as EU foreign subsidiaries, although I will show you that in robustness exercises we find that excluding these banks does not affect our main results. We also match the data with quarterly balance sheet data, and later on in the later part of the analysis, we also match this with firm balance sheet information. In terms of the definition of the non-performing loan, it's fairly standard. We follow both the academic literature and the policy documents. By NPL, by non-performing loan, we refer to loans that have been more than 90 days past due. And as a preliminary, graphical evidence, just to show you what happens with respect to the vintage, the evolution of the vintage over time, I'd like to show you a graph where we plot the NPL vintage over time during the sample period. And I think it's evident that the median of the vintage and non-performing loans declines, especially more so in the later part of the sample period, especially following the introduction of the ECB guidelines in 2018 Q1. So, if anything, we have some preliminary evidence that banks actually do get rid of the older non-performing loans, the vintage NPLs. So that is a preliminary analysis. Now, let me move into the empirical specification. So the first question that we ask is whether the vintage of the non-performing loan matters for the probability for the bank to dispose the loan. We're using a model where, and I think this is the appealing characteristic of the data, that the vintage of the loan, we observe it at the loan level. So that allows us to define, if you like, the treatment at the loan level. And that improves our specification in terms of using a number of fixed effects. In terms of definitions, what we have is a dummy for the disposal, whether a bank disposes a non-performing loan in the next quarter or not. We define the vintage as the logarithm of 1 plus the number of months in default. We also define a dummy for the post-policy period. We use a number of loan level controls, and the analysis is conducted on a period 5 quarters before and 5 quarters after, so we use a symmetric window. And we use, as I said, a number of fixed effects, for example, bank time fixed effects, firm time fixed effects, bank firm fixed effects, and more importantly, loan category fixed effects, because we have loans of different types, and that would matter for the probability of disposal. So, in this first model, therefore, we are interested in finding what's the effect of the vintage, or put it in a different way, whether banks are more likely to dispose a loan in response to increasing, let's say, vintage by 1%. And then we're looking at the coefficient of beta that would allow us to test out what happens to the probability of disposal for vintage loans in the post-policy period. So the general finding is that banks are more likely to dispose of older loans following the introduction of the policy. If I can give you some numbers just to see what's the economic importance. In our preferred specification, where we use the largest set of fixed effects, a 1% increase in months for a loan categorized as non-performing increases the probability of disposal by about 1.9 percentage points. And when we look at the sum of the coefficients of alpha and beta, as I explained in the specification before, that means that 1% increase in months classified as NPL, that increases the probability of disposal by about 3.3 percentage points. And that would take us to the table, the first table that looks at the probability of disposal. So I refer to column 5, where we have the model that saturates with the greater amount of fixed effects. So that's where we show that not only larger vintage increase the probability of disposal, but the effect is amplified in the post-policy period. So, if anything, our first result is that following the policy, vintage loans are more likely to be disposed by the banks. We try to check the robustness of our findings, and we conduct a number of tests. For example, we drop the NPLs that had the largest decline, the largest drop over the years. We also drop banks that have low NPLs overall. We also drop banks that have very different business models, for example, rural or foreign banks. And finally, we take into account the possibility that the construction and the real sector, they might have been influenced by the shock in the European debt crisis. And for this reason, we drop these sectors as well. What we find is that our main results hold. We still observe that in the post-policy period, vintage non-performing loans are more likely to be disposed. To reinforce our results, the first set of results anyway, we also attempt to conduct a regression discontinuity design around the policy-induced cutoff points. As you might remember, when the ECB released the guidance, there was, for unsecured loans, there was a cutoff period of 2 years, above which loans should have been fully provisioned. For secured loans, that was starting from 3 up to 7 years. So we take into account these cutoff points, and we run an RTD. What we find, I must admit that this is still in kind of starting stages. We're trying to explore this further. But the evidence that we have so far shows that in the post-policy period, for the induced levels, by the ECB, the disposal is greater, both for secured and for unsecured loans. So this is the summary of for the first set of results. Now, before moving to the second type of analysis, the credit supply analysis, let me just show you whether there are any pre-trends. So what we do, we repeat the analysis before. So we rerun the model that I showed you in the previous slide, but instead we replace the policy dummy with time dummies, and we find that there is no significant change in the disposal of NPLs in the run-up to the introduction of the ECB policy. So that gives us some evidence that there is no evidence of pre-trends in our analysis. I'll skip the results about profitability. Let me go to the second question. So far, we've seen that banks are more likely to dispose non-performing loans after the introduction of the policy. The next question is, okay, so what happens now to the supply of credit? Do banks react, and in what way? To answer this question, we estimate a standard credit supply regression, where on the left-hand side, we have a number of outcomes, actually, not just the supply of credit. We look at new credit, we look at the probability to terminate an existing relationship, we look at the amount of collateral required, etc. But the idea is that we have a model where we interact the policy dummy explained before with a weighted average of the NPL vintage. So this is weighted by the amount of credit, and then a bunch of controls at the firm bank level, plus standard fixed effects that would allow, including firm time fixed effects to control for demand, that would allow us to give a supply side interpretation. So going to the results, so the second key finding is that banks with higher levels of vintage, they actually reduce lending, especially given that we are looking at multiple banking relationships more than other banks. What is the economic interpretation? Well, a 1 standard deviation increase in non-performing loans vintage, that roughly corresponds to about 1 point, which corresponds roughly to about 2 months. That actually reduces credit by 2.7%. By 2.7%. And looking at the table of results, where, as you can see, we show this reduction in credit. We also find that there is an increased probability to terminate an existing relationship, and we also find that following the policy for banks that have higher levels of vintage, they also ask for greater amount of collateral. So this answers the The second question regarding what happens to banks. So far we have seen that banks are more likely to dispose bad loans in the aftermath of the policy. This appears to have an effect on their lending, which we claim it happens through an accounting mechanism, simply because banks have to increase provisions, they take a hit in their profitability, and for this reason they're becoming extra cautious. So if you like, they recalibrate their lending model, and that results in a decline in lending. And once again, looking at pre-trends, we fail to find any evidence of pre-trends in our analysis. So that gives us some comfort and allows us to proceed to the final question. So given that banks are more affected by more exposed, to these policy guidelines, cut credit, what happens to the real economy? Does this shock transmit to companies? So what we do now, we take this analysis at the firm level, so we aggregate it at the firm level. We take the difference between, now this is yearly data, so we take it, the difference between 2017 and 2019. And once again, we compute a weighted average of the non-performing vintage loan at the firm level. And on the left-hand side, we run regressions where we have a number of different firm outcomes, both real effects as well as financial variables. And the dependent variable therefore measures the growth between the end of 2017 and 2019, i.e. before and after the introduction of the policy. And we look at the growth in committed credit, assets, number of employees, tangible fixed assets, and sales. Once again, the main result is that there is a reduction in the growth rate of bank debt for firms that rely more heavily on exposed banks. So this result, if you like, reinforces our previous analysis about credit supply, but we obtain this result now at the firm level. In terms of other real outcomes, we find that a 1 standard deviation increase in non-performing loans decreases the growth rate by 2.3 percentage points, and we also find a reduction in employment growth by about 0.7%. So taking a look at the table where we look at the growth rates between 2017 and 2019, you will notice that we have a reduction in employment, investment, assets, and sale. So if anything, for those companies that rely on banks affected by the shock, their firm level outcomes are negatively affected. And in the last 2 minutes, I will very briefly touch upon the fact that we try to understand whether this effect is the same for all firms, but apparently not firms are affected the same, and we do find that the effect is stronger for the riskier firms. So very briefly, looking at this table of results, you will see that when we interact the vintage with the riskier firms, the result is more pronounced for bank debt, employment, and investment. So not all firms are affected in the same way. Risky firms are affected the most, and this is significant because it's important for policy as well, because these are the firms that they take the most important hit. So let me conclude again by saying that the purpose of this study was to look at the release of the ECB provisioning expectations in 2018. We wish to use it as a quasi-natural experiment and study changes of this policy in terms of the dynamics of the NPL, the bank lending, and the firm dynamics. The evidence that we find is that banks actually dispose of NPLs at a faster rate, but this has a negative effect on their lending, and then this translates into negative firm-level outcomes. There are heterogeneities both at the bank and the firm level, and if there is a policy conclusion that we can draw, we can highlight that banks can be myopic and keep non-performing loans on their balance sheet, But against this backdrop, what we document is that supervisory oversight was very critical for banks to clean and repair their balance sheet. And with this statement, I'd like to close my presentation. So thank you very much, everyone, for your attention.
Thank you very much for the presentation and for being on time. So now we are moving to the discussion of this paper. The discussant is Daniel Paravisini from the London School of Economics.
Great. Well, thanks for having me. It's always a pleasure to come back to this conference. So this changes, right? Okay, cool. The question is, what does regulatory oversight or suggestions on how to provision NPLs, what are the consequences of this in the banking sector? The setting was the announcement by the ECB on 2018. The data is from Spain, and the results are what Serafeim said. In terms of the mechanism, I think that the preferred interpretation of mechanism, the paper is somewhat unclear, and this is a great opportunity because this is where I'm going to go at. I'm going to take the results as given. I hear the paper is already R&R, so I'm not going to give any new ideas to referees. I'm just going to talk about the economics. And the way I'm going to tell the story is basically tell the story of a loan that's performing and follow it through all its stages. First, you declare not performing, then you provision it, then you write it off. This is the simplest path. There are many different possible paths. This is the simplest path. And think about this path through the lens of the capital adequacy ratio. So the idea is the idea of looking it through the capital adequacy ratio is precisely to attach a cost to the bank to executing each of these steps. Okay, and I think this serves the purpose of, as academics, we tend to, write regressions and run, estimate regressions where a loan either defaults or doesn't default, and as it matters, there's a lot of nuance on exactly what it means in each of these stages. Just having non-performing versus provision versus writing off. Each of these things have very different implications, so it's going to be useful. And once I tie it to the cost, then we're going to talk about the economics of this. The implications, if you want. And then this will lead to suggestions of what to do with the paper. So I'm going to follow an example loan. Imagine a 10 million euro loan that in the book value of the loan is going to show up as 10. Let's assume it's an ex-ante, super safe loan. You're an IRB bank that just attaches a risk weight of 20% to this. So in the formula, of the capital adequacy ratio, this counts as just, and then in the denominator, it only counts of the $10 million loan, it's only going to add up $2 million, euros, sorry. And I'm going to have a sense of a cost, I'm going to assume a target ratio of 10%, so that then every time there's a change, we transition from performing to non-performing, performing to provisioning, I'm going to ask the question, how much capital would you need to restore the target CAR from, in that change? So that's going to be my measure of the cost. And you can think of that as how much additional capital you need, or if you can't change capital, how much you need to cut lending in order to restore. So that's the flip side. Okay, so that's going to be the story. So from performing to non-performing. So remember, the performing loan has the value in assets is 10, risk weight is 20%, so its contribution to the risk-weighted asset is 2. Suppose that it transitions to non-performing. When does it transition to non-performing? The standard mechanical way is that the loan is 90 days due, late in repayment, overdue. But there's a non-standard way, which banks actually have a lot of control over, which is there's an assessment by the lender that the loan is unlikely to be repaid. So just to say that the transition from performing to non-performing is not just mechanically you are 90 days late. There's a lot of other ways you get there, okay? And there's a lot of discretion on that. So when it's non-performing, I'm going to pick exactly what risk weights you would have when the loan is non-performing. Depends on the regulator, the type of loan, etc. I'm going to pick some numbers here to make the example way extreme. So suppose that in this particular case, the risk weight when the loan is non-performing is 150%. Okay? So that means that the contribution of this loan to the denominator is going to be 15 million euros. So, which means that when you transition from performing to non-performing, the risk-weighted assets go up by $13 million euros. Okay, so in principle, in order to restore your original ratio, you have to increase capital by 1.3 million euros. Okay, now transition from non-performing to provisioning. What provisioning does is basically in the income statement you declare, I'm not going to receive this money. This loan, I'm never going to collect it, so you acknowledge the loss. So in your income statement you say, let's assume in the extreme case that I acknowledge I'm going to receive not a single euro of these 10 million euros. This shows up in the balance sheet in two ways. Obviously on the equity side, you just have the loss of 10 million euros. On the asset side, you don't just cross out the loan, you create a counter asset for minus 10 million euros, so it cancels out the asset side. But the key thing is that when you look at the capital adequacy ratio, two things are happening. First, on the asset side, the risk weight this might sound weird, but even something that you have fully provisioned could still have a risk weight there because they don't want you to have that in your balance sheet. That's bad. So I'm going to just, in this example, I'm going to pick a risk weight of 50%. So this loan, even though it has been fully provisioned, might still show up in the denominator. But the key thing is that your capital dropped by $10 million. Okay? So in order to restore your target capital ratio, in this case, after provisioning, you would have to raise additional $9 million of capital. Okay? So this, you can see clearly that the magnitude of provisioning, the cost, if you measure the cost in terms of regulatory ratios that you have to adhere to, provisioning is way more costly to a bank than just declaring an NPL. Okay? So that's kind of one key thing. The other key thing is that there's a lot of heterogeneity in this because the different banks will have different costs of deviation from the target ratio, different cost of raising equity, different cost of adjusting lending. So all these things are going to determine how, in the cross-section, which banks are more affected by this type of policy. And of course, the loans, the same thing. A safe loan, given that the target, suppose you need to cut lending. If you cut lending on safe lending, you'd have to cut a ton of lending in order to reduce the denominator of that ratio because safe loans are multiplied by a small percentage. Okay, so this channel, if you want, can predict a lot of heterogeneity. Then from provisioning to write-off, this is not that interesting, but in the example I constructed, the bank actually gains. Once you've provisioned the loan, you have lost the advantage of not having recognized the loss of the loan. Actually, in this example I constructed, the bank has a benefit from writing their loan off because you completely wipe out the asset from the denominator of that ratio, and you basically now have a capital credit, if you want. Okay, so in this example, you even it creates and it highlights the incentive that banks have when a loan has been provisioned to write the loans off. Sure. What are the implications of this that I think are important for what they're doing? There's two. I'm going to talk just about risk discovery. Banks were living comfortably here, right? You declare loans non-performing, and you don't have to provision them. And this is good from the perspective of capital ratios. This is an advantage. Now, the ECB comes and nudges you towards provisioning, which is going to be very costly for the banks. The key thing is that, what's definitely going to change that, banks, the incentives of banks to declare a loan non-performing are going to change dramatically because you're not going to be able to sit in this intermediate comfortable state where it's costless. So what's very likely going to happen is that this is going to change. So the likelihood of banks to declare non-performing loans is going to change. So there's this trade-off between knowing where the risks are and knowing what the risks are and where they reside and how large they are, and be able to force banks to provision accordingly to them. I think this policy has a trade-off. When this policy should, in principle, have a large effect on the likelihood that banks are going to declare non-performing loans. And then this creates two problems for the analysis. The first one is that evergreening, in principle, can cause an NPL to exit the dataset. Suppose that there's a loan that's 90 days late, and I issue another loan, fresh new loan, which you used to repay the previous one. I don't have to disgorge a single euro in cash, and suddenly the NPL disappears. In the data, this is going to show up as the loan was disposed of, and that's a problem. Okay, so you might be confusing disposing of loans with evergreening, and that's a problem. And the other thing is that, in the flow analysis, I'm going to finish with I know Serafeim is from Greece, so I wanted to finish with a plot from Greece. When you're looking at the stock of these counter assets you're creating, you have two flows. He's looking only at exit, and the discussion here is suggesting that the entry into non-performing is changing. So if you want to analyze changes in the stock of this counter asset, you need to analyze both flows. And that I finish with a picture. This is Greece. Okay, I just happen to have all the balance sheets of the banks in Greece in my laptop. So these are the top four, actually, not five. The top four systemic banks. These are reserves for loan losses. This is basically every time you add this counter asset, you start adding that up. And this is basically, after the financial crisis, the total amount of reserves for loan losses created in the Greek banking in these four banks. And, it's kind of very striking that it goes from 5 billion euros to 47 billion euros and then back. But this hides a lot of action. If you actually look at the changes in the stock and decompose them by entry and exit, this is how the plot looks like. Oh, sorry. This is how the plot looks like. So blue are provisions and impairments. These are the flows into that stock. That is basically your provisioning for loans. As you can see, the pattern is there was low provisioning, then there's 5 years of a very high provisioning, then it drops again. And then on the negative side, in orange, you have write-offs, and in green, you have transfers due to sales, so basically you're securitizing. And you can see that these are different dynamics, and these things are happening at different points in time. And the key thing is, I was missing something like this in your paper. To really understand the dynamics of NPLs, you need to understand the flow in, the flow out. The incentives of both are changing with this policy, and if I had to push you in one direction, it would be in this direction. Just show me the entire dynamics and not just the exit rate. Thank you.
Thank you very much. Now, do you want to answer, or should we proceed to take questions?
We can take questions and I can answer.
Okay. Questions from the floor? Javier, please.
Thank you very much. In some sense, the main outcome that you obtain is expected, no? That by forcing the banks to fully write off previously recognized NPLs, this is going to have a negative impact on those banks' capital and potentially on lending. Is sort of expected, no? But maybe the analysis is not trying, and so I'm suggesting a potential room for expansion of the analysis to identify the potential advantages of this policy, because the way I could read your results is so far so negative, no? Because the new lending by the most affected banks shrinks, and the employment and investment and lending to the most affected firms shrinks. Yes, but of course, why was this policy put in place? Not to produce those effects per se. This policy was put in place under concerns of zombie lending. So maybe actually a positive reading of those effects is that you were killing some zombie lending with the policy. And then you were making banks' balance sheets cleaner, potentially benefiting the industry as a whole. So maybe damaging the most affected banks in terms of having to recognize losses and realize capital losses and lower lending capacity, but maybe the industry as a whole then look cleaner and with the capacity to grow. So I think what is missing then in the analysis also of the real effects is whether there are positive externalities from what you are measuring currently, like bank by bank, when forcing to sell these loans. There could have been a reallocation of lending towards more efficient firms, or there could have been dynamically a better perception about the bank industry, better capacity to get access to the market. So in a sense, I just want to say that the ECB policy was not a crazy policy directed to make the banks suffer just for the sake of it.
Yeah, thank you very much for the presentation. Related to zombie lending again, I thought you mentioned something about the relationships that were broken. You have some results about that. Okay, great. So yeah, I was wondering what those results are in more specific terms. And the second thing I was wondering is whether you have any way to actually measure whether this policy has a persistent impact on the way banks lend to risky firms. What I'm wondering is the following story. So now I know that I have to immediately dispose of a non-performing loan, and hence I try to keep, I do less risk-taking than I would otherwise. Yeah.
Okay, so we end with this question.
Simple question, like, I want to understand what's happening on the overall bank portfolio. Like, are these banks downsizing their overall portfolio? Are they rebalancing their portfolio, like related to what happened, also the discussion? Like, are they turning to cash securities, something like that? It will be nice to understand what's happening. Because, like, if we look at the data, these banks were actually increasing the portfolio in this period, the overall assets. So just to have an understanding of that.
So thank you very much. Thank you, Daniel, for the discussion. Thank you very much for the questions. So to answer the question about looking at the entry and exit of loans, yes, that makes sense. We should be able to check that, see what happens, and that would allow us, I think, to disentangle better how the policy works. But related to Gianmarco's question, I don't have an answer on top of my head. I think we should look into that. I don't know whether banks, change, their portfolio in different ways, but the data are there, so we can definitely look into that. Regarding zombie lending and evergreening, again, this is an issue that we can definitely explore. I don't know. I don't think we have looked at whether banks in any ways extend lending to risky borrowers. But in terms of whether whether we paint the policy with not so bright colors, the truth is that when we look at the heterogeneity, both at the bank and the firm level, we find that there are differences, and not all banks are affected the same, and not all firms are affected in the same way. So it's not the case that, for example, banks cut credit, across the board. Some firms are more exposed than others. So yes, the effect overall appears to be more negative, if you like, because it affects, lending, but this negative effect is not across the board. And more importantly, let me also emphasize that what we show is a kind of a short-term effect that we are looking at. It could be that potentially in the longer term, this negative effect reverses, and we have, an increase in the supply of lending. This is beyond the scope of the paper, but that could, answer the question that in the longer term, things might be brighter.
Okay, so with this, we close the session. Thank you very much. And we move to the next session directly.